Good afternoon, everyone. Good to have you with me. I'm Brett Crowther, back again for another version of Short Verticals. And sorry I missed last week. I was out in Atlanta doing a workshop, a stocks and options workshop, and it was really fun to get to meet a lot of people down in that area. And so I don't know if I met a lot that were in this class, but if you were in that Atlanta workshop and are in this class today, well, welcome. Good to have you with us today. I got to give a shout out, my good friend Scott Thompson is handling chat. Normally Cameron May is taking care of that, but Scott's on it today. So we appreciate him stepping up and helping out, kind of a last minute thing. So, hey, we got a lot to cover today. We're going to be looking at the overall market, just seeing what how channels can help us there. Then we're going to look at our trades that we have going on. We have one on Uber that we need to talk about. We'll follow up on some of the stocks we talked about at the end of the last one I taught, which was 2 weeks ago, and then we'll look through a bunch of stocks and see what kind of paper trades we can place, and see what's setting up for some potential analysis and trades. Okay, so we'll go right through that. I just want to give a shout out, Will, Richard, Judge, how you doing? It's good to see Paul, Eric, George, everyone. Good to have you with me. Thanks for joining. So before we get into that, give me about 20 seconds here to cover some disclosures. Do remember that what we talk about today, well, options, they do carry a high level of risk and are not suitable for all investors. Information is for general purposes only and should not be considered a recommendation. Paper money trading is for educational purposes only. Short options can be assigned at any time, whether you're in, at, or out of the money. It doesn't matter. You can be assigned at any time, so be aware of that. Investing does involve risk, including the loss of principal. Past performance, not a guarantee of future performance. And then here are your definitions for the option Greeks. And last thing I want to just bring up is we don't use stops much in this class. I've gone over why we don't use stops, because it can alter your probabilities on a trade without you really understanding, without any of us, kind of knowing how it can alter our probabilities when we're trying to do a probability trade. But when you do, just understand that stops, you may get billed at a price different from what you're setting there because it can become a market order. Okay, so with that taken care of, let's jump out there and let me actually delete some of the stuff. Remove this because I want to talk about what's going on here. We got more lines than one. Okay. Oh man, no, I deleted the wrong one. Let me just activate this one. Here's what I wanted. We're going to zoom in on this. Just got to get it set up here. Got all kinds of things going on just so we step out. All right. So what we've had, if we've talked about the overall posture of the market, right? In many classes and stuff. And for the last several weeks, we've noted it's kind of been sideways, right? It's gone through this channel where it's really been bouncing off the top a couple times. So we've had a couple hits up here, down here, up there again, down here again, up there again, down here again. So it's kind of a bouncing back and forth in this channel that you can see I've drawn in here. Now, more recently here, it kind of broke through it and rallied back up. And you can see kind of a little retest right there with maybe a shooting star type formation as it went down. So now the question is, if we just look at this and just say, okay, where's the market going right now, right? This is the SPX. Where is the overall market going right now? I mean, we had the Fed announcement come out yesterday. They're going to keep interest rates at 3.5 to 3.75%. They talked about only having one cut potentially in 2026. That left investors a little bit jittery, worried that maybe they're not taking into account some of the geopolitical issues that are going on out there, some of the oil, issues that could impact prices and, hinder the market. Well, all that considered, here's where we're at. We're seeing the market kind of drop down a little bit. Now, when we take this into consideration, the question is, where is it going to go, right? As we see it break from that level of support and head on down, break out of that channel. Well, one thing about channels that we need to remember, this is very important, is that channels can repeat themselves. In fact, that's why I had one above it. I'm just going to actually, let me delete this. I'm going to grab that and duplicate it. And if you recall, before I said, hey, this, oops, not activated. I want to duplicate it. Let's try that again. We're going to duplicate drawing. Okay, got it. Yeah, now there we go. So it could go, if it broke out the upside, it could potentially go that distance. If it broke to the downside, it could potentially go this distance. And look at where it's at right now. It's actually kind of right at there, maybe even breaking below. And so this is where we anticipated the market hasn't closed. And so we'll see where this closes. But if it's somewhere in this ballpark, and by the way, this is drawn a little too thin. When we're looking at support and resistance, we're not looking at, this, 660 what are we looking at? Like, I don't know, 660, 04.92 or something like that. Yeah, it's not that, right? It's this general area right in here. Okay. So we should draw that with a crayon, a big fat line in there. That's what I'm saying. It's kind of at support right now. So we'll keep an eye on that and see what happens as the market closes. Now, if it does break down through that, and we have seen, the downward pressure here on the RSI, so the market has been dropping down. There is some potential of some old support back in here. So let's just draw that out and see how that plays out. This could also be support just below that. And so there's a couple levels of support that are kind of right in this ballpark that it could potentially bounce at. And so we'll see. So short term, it's just dropping down. It hasn't necessarily turned bearish. I mean, how far off the high are we? I'm going to grab our drawing tool here and pull this down. So if I draw, the high was right up in here, right? So if I pull that down, it'll tell us we're down about 6.6%. Okay, so haven't even had a correction yet. We're looking at about 10% to get the correction. So we still have a long ways to go. We'd have to get down here around the 6,300 mark to get a 10% correction. So still a long ways to go for that. So this is simply just a little, as it sits right now, simply a little pullback in the overall upward trend, just a little hiccup, right? And so we got to keep that in mind, and I want to back out here and just show you, we've had times like, look at this move right here, right? This drop down right here, which is very similar to this move that we had right over here. But, and that went on for, I should have kept an eye on that. That went on for how long? About 27, a whole month, right? That dropped down for a month. And this is the problem, is we tend to get a little hung up on, oh, it's gone down again today, and now the next day, yep, down again, the next day, down again, next day, down again type thing. And so when you build up enough of those again and again and again, our memory starts to remember all these recent days of it's down again, down again, down again. It starts to give this feeling that it's down a lot more than it is. But if we back out and look at the big picture, it really isn't down that much. So keep that in mind. Now, let me show you another stock. I was looking through some stocks that we could potentially place some paper trades on. Just doing some scans today. And let me scroll down and just make sure I'm not missing anything. Hey, Mickey, how you doing? Good to see you. And by the way, I responded to some of your comments on X. Let's see, okay, just me. I don't think I'm missing anything. All right. This was interesting. So initially, I was looking at JP Morgan here, and I have the support line, this yellow one right here. Well, one thing, let me redo this so you can see how I did this. So when I saw that, one thing that channels can do, going back to the power of channels, is when you see that, and this is a very clear support level, right? I mean, it's there, it's clear. There's not a lot of argument about it. But where's the resistance? And this is where it gets a little bit more, well, it could be there, it could be there, it could be there. One thing about channels, if we bring it up and encompass the entire price action like that, so we know about the support really well. It's the resistance is a little bit out there. But look at this. I'm gonna incorporate all the price action as I brought up that resistance line up to the top of the price. And if I go ahead and right click on that and then I edit that, it will allow me to, pick in some coefficients. I'm going to put on the 0.5 right here. And when I do that, hit OK, what are we going to see? Well, we're going to see it draw that 50% line. And what we're going to notice is this actually started picking up some of these areas where it found resistance and support kind of midway through that channel. Now watch this. I'm going to duplicate this. And this time it broke down. So as I pull this down and put it right there, look at this. Look at this. Look at how it dropped down and found support basically on that channel again. So you see how it kind of repeats itself? Now, what we could potentially be looking for here on JP Morgan is a rally back up to this resistance, and then possibly, come back down and use these as potential supports or break, through one or two of them. But, that's where the channels can really help us out. So if you see something in a channel, use that as an opportunity, get some guidance on where some potential areas might be. All right. Market is on the struggle bus, says Ricebird. Ricebird, how you doing? Good to see you. I mean, that's fair, right? I mean, the market isn't like screaming up or anything, but it's also not screaming down. It is struggling. It is struggling a bit right now. Okay, so let's do this. Let's go over to the trade tab. Let's take a look at what we got going. Not trade tab, monitor tab, sorry. So we have Uber going on, and this is a trade we placed back before I left. Well, I was out. Oh, by the way, a real quick story. So I mentioned, hey, I may not be back because either one, I'm going to be in jury duty, or two, I'm going to be at a workshop. And it's kind of like if I had jury duty, which selection was that Monday, the the trial would take it past the time I get stuck and I wouldn't be able to go to the workshop. And so I didn't know if I was going to go to the workshop until after, Monday to find out what happened with jury duty. Well, I got down there and I wasn't selected. I was kind of bummed. I wanted to be part of the process, and I have never had that experience, but I wasn't selected, and so that allowed me to, not be tied up for the workshop, and so I was able to go to the workshop. And so, but either way, I was out last week. And so, how are we doing with this? Well, we have this trade that's on right now, right? This is going to go out to the 17th of April, and it's just a trade that's kind of just chilling. I mean, we're up what, $72, and so here's the great thing about vertical spreads. This is where they're very forgiving. Let's go over to Uber. Speaking of Uber, I used an Uber a time or two while I was going to Atlanta. And so, we're looking at this downward trend. It came down, bounced off some sort of just kind of bounced, right? There wasn't support here necessarily, just bounced. And so we drew some Fibonacci's on here to give us an idea of, as it rallied up, where would it retrace to? And then here's where we place a trade, looking at it bouncing off that Fibonacci level, 38.2, and looking for it to go back down, which it did. But then, just a couple days ago, it jumped up, right? Big solid jump. Now, this line, this is a 50% 50%. This is a 50 period simple moving average. And as you can see, all stocks will kind of follow their own moving averages. Not all of them will listen to the 50. Some will listen to 30. Some will listen to the 20. This one, if we look back, it tends to do a fairly good job at kind of bouncing. It comes down, it kind of bounces, going sideways here. It doesn't tend to follow moving averages at all. But when it's trending, more trending, it does tend to follow that moving average. Once it broke above it, now it came below it, resistance, resistance, resistance. And so we'd anticipate it to be resistance over here, right? And when it gapped up, this is where sometimes we have to sit on our hands on these types of trades, because we get you can get anxious, right? A little bit edgy as we see something like this where it gaps up. Well, it gapped up, it had a shooting star formation, and then we had a confirmation of that shooting star where it closed below the body, and down it goes again. And this is not a shooting star. Does anyone know the difference why this one is not and that one is? Does anyone know real quick? Dragon Rider, how you doing? Good to see you. So I'm just curious if you guys know. And by the way, if you're not real solid on candlestick patterns, let me just show you here real quick. Let me pull this over. So I actually just did a short today. So go to our Trader Talk homepage. You can go to shorts right here and click on that. So yeah, do me a favor, just go do this. Check this out. Click on the shorts. And I just did one today, bearish Harami, quickly explained it. So I went through and talked about, okay, what is a bearish Harami? What are some nuances about it? What do we need to know about it? What are some other patterns that are very similar, and what's the difference? What does it mean, right? And what's the psychology behind it? Which I think is actually more important if you understand what are they thinking more than even what it's called. Because if you understand the psychology behind it, you don't really need to memorize the patterns. You just need to say, you're able to say, oh, okay, I get it. The bulls were bullish here, and then they became indecisive, and the bears took over, or vice versa. And that's what I go through. So we just got it posted a couple hours ago, so go check that out. But there's a whole bunch of them in here. I did the bearish Harami because it was actually requested by you guys in the comments. And so do read the comments. So I appreciate that, because I did a bullish Harami. I don't know why I wasn't even thinking about a bearish one, but then someone said, hey, can you do a bearish one? I'm like, sure. So I did that. But we have, morning star, evening star. I have a whole bunch of candle patterns in here. So go check those out. And if you haven't subscribed too, please, subscribe to our channel. That will help us out, and make sure we can continue bringing you these webcasts. So what is the difference between them? It's not the price gap, but good guess. It's okay. So here, first off, when you're looking at candles, always look for resistance. I mean, you can have all kinds of candles in between a run, and they really don't mean much. I mean, if we're talking about the strength, the validity of this indication, it really isn't there unless it's at support and resistance. Then it really comes into favor. And by the way, I did a YouTube short on what's the difference between a shooting star and an inverted hammer. And let me show you something real quick why this is important to understand. Because the inverted hammer looks like this. a shooting star looks like this. They look the same, and they actually are the same. And so this is what I'm telling you. Support and resistance means everything with these candle patterns. So go check out that short that I did on that, on the difference between a hammer and a shooting star, and also an inverted hammer and a shooting star, and also a hammer and a hanging man. So let me get rid of these though. But the difference is really what we're looking at here is the length of the wick. All right. On a shooting star, the wick ideally is 2 times the length of the body. All right. And so if we're looking, oops, don't want to do that one. I thought I had my drawing tool. So right here, if we look at this, that, the body is only this big, and you can see this is at least, 2 times that, right? Where this is just kind of like 1 time it. And so it's not officially a shooting star. And the psychology behind this is really important, because this means that the bulls pushed it up really hard, but they couldn't hold it, and the bears took it right back down pretty strongly, and so there's more of a bearish pressure on this candle than there is on this third candle here, the other one. And so that's where it's really good to understand this. Okay, but let's get back to the trade, because I do want to make sure we have time to go look at a whole bunch of stocks. On this trade that we're looking at, it's doing okay, right? I mean, it gapped up, nothing wrong. And that's what I'm saying is like this, the great thing about these is they're forgiving. So it gapped up, it came back down, and right now it's just sitting nicely. It's within our green box area. We need it to be below this level up here around 77 by the time we get over here to April 17th. And so far it's just doing its thing. We just got to give it time. We got to be patient and sit in our hands. Okay. So all is good. All right. Okay. Thank you, Mike. Appreciate that. It's like my style describing that. Appreciate that. And thank you, BJ. Yeah, you guys are good. Appreciate it. Okay. Helpful. Thank you, Journey. Okay. So let's get out there. We're gonna leave this one alone. So we're just gonna leave Uber. It's just these are time trades, and it takes time. That's all it comes down to. Is it just takes time. So we're just gonna have to sit on our hands and just let it go. So with that said, though, let's take a look at a couple out here. Now, this is one I wanted to talk about, ANET. So ANET is interesting. Notice how this one has been just, the market has been going sideways and actually pulling back. And what's happening with this one? Well, it's bucking the trend. So Arista Networks has been bouncing off support multiple times. And you can see all the multiple hits here. 1, 2, 3, 4, 5, and it's kind of channeling right there, kind of hanging out. And we can also see that it's not just that, but it also has some support on the RSI. I'm just wondering, it's probably along here, I'm guessing. Yeah, something like that, right? And so you can see it's bouncing off the RSI. So we get this bullish pressure coming up that's been pushing the stock higher and has really held it up there a bit. And that could open up an opportunity to do something. Here's a stock that's bullish, slightly bullish to bullish. Maybe that opens up the opportunity to go out there and put on a short put spread, right? And so let's go take a look at this. And I want to actually break down something important as we look at this about selecting strike prices and whatnot. So let's jump over to the trade tab. And, we can look at this as we got 22 days in the April 10th, we got 29 in the April 17. And, I was looking through some earlier, and where's one? I want to actually pick the April 10th. Now, this is kind of short. There's not a lot of time in there, but I want to illustrate something I think is very important. So if we were just to go out there and select something with a delta of around that 30 to 40, so let's pick something, and let me see what I looked through earlier, like a 129, something like, okay, here's a 33. Here's what I want to do. Now notice these are each dollar. Some are, depending on how the stock is priced and whatnot, how high the stock is and the volume on it, they can be, $1 wide, they can be $5 wide, they can be $10 wide. But one thing I want to do is, let's say we want to look at this and say, okay, I want to go ahead and sell this 129 put. So I'm going to click on that and get the sell order in there. And then I'm going to want to buy one for protection, right? And so I'm going to right click and hold on to that. Excuse me. Earlier when I was looking at this at 25 cents, I'm going to use that because it makes the math a little easier. And so what we have here on this, let's do, we've got a short put here. And this is the 129, 128. All right. And so with that, we get a credit of 25 cents. Okay. So what's the risk on that trade? Well, the risk is the difference between it, right? Because if the stock goes down, someone's going to stick it to us at 129, and then we can turn around and stick it to someone else at 128. So the most we could lose, even if the stock went to, $85 or something, the most we'd lose is $1. But we'd keep that credit. And so that means our risk on that trade is 75 cents, right? Okay. Now, what's the ratio there? So if we take, our potential return and we divide that by the potential loss, that gives us a ratio of about 0.33. Risk return ratio is 0.33, not 0.33, but 0.33. Okay. So here's the question. What about, is it better to go one strike wide? When you can select every strike, and by the way, there's more than this. I just happen to only have 14 showing. I can show all. If do we select something else? Like, would we go with the 130, 129? There's all kinds of opportunities here. But what I want to show right here is, what about if we change that? What is better? Is it better to do, a dollar wide, or is it better to do $2 wide? Is it better to do $3 wide? Hang tight with the why don't I go the 17th. The reason why I don't want to go there yet is because I want to actually illustrate a concept. These numbers are working out really well to illustrate, at least when I ran through it earlier. Hopefully they'll still work out the same way as when I was preparing for the class. But what if we did a 129, 127? So, let's say we did, this would be almost like, what if we did one contract of this and two contracts of that? That'd almost be the same, right? Meaning it would create kind of the same risk in a way, because now our risk on this is the difference between $1.29 and $1.27, and so that'd be $1 risk where this only had or $2 risk where that only had $1 risk. And so if we did two contracts on this one, it'd have the same risk, just without the credit. It'd have the same risk as this one. And so let me walk you through this though, and just show you something I think is interesting. So if we do this, let me unlock that. Oh man, it's changed dramatically. This is killing me. So earlier today when I did this, I was looking through this earlier. This is actually 75 cents. So it's killing me that it changed that much. I can't believe it did that. It kind of narrowed in, but I'll just change it to 70. But this is quite common. So even though this one changed, and it's not sitting where I wanted it to illustrate the concept, I do want to point out that this is fairly common and something you're going to see when you go to a two wide spread. So, assuming we could get a credit on this one of, again, it's not there now, but it was earlier, of 70 cents, then now we have the risk of $2 wide, right? Because someone puts it to us at 129, we could put it to someone else at 127, we'd lose $2, we'd keep the 70 cents. So that would give us a risk of $1.30, right? Now that gives our risk reward ratio of what? Again, I apologize, the numbers changed on me that much. I really didn't think it would. So we got what, 70 divided by 130? That's a 0.53. Okay. So which one offers a better risk reward ratio? So that's the question, and that's what you ought to look at. That's how you can really determine which one, can be a better play, is take a look at that risk reward ratio and see how it plays out. And sometimes you're going to find that the dollar wides are better. Sometimes you're going to find out that the $2 wides are better. More often than not, and one thing to keep in mind is, there's also commissions on things. You got to do twice as many on the $1 wide to get this, get the same as you would on just the $2 wides. So keep that in mind. But play with the numbers and see how they go. All right. Let's see. Let me just make sure I'm not missing anything. Less than double the gain for double the risk. It's not double the risk. It's like if you go through your math, if you go through and you say, okay, but if I did two of these, so like here's the deal I want to say. So if this is kind of the how it plays out if we did one of each, but obviously this is double, right? So if we doubled this and said, okay, if we did two of those, then we'd receive 50 cent credit. and then we'd have a risk of $1. Well, we'd have a risk of $1.50. You see what I'm saying? So keep that in mind. It looks like we have a survey as well. Scott has reposted out there, so please fill out that survey. You know, Scott and I both read through each and every one of them, so please fill that out. Okay, but so this is an important thing. Let's actually, I want to check one more thing. Let's just check it. It has moved. The stock has moved a bit. We could still make a trade on this. This moves from where I was looking at this morning. It hasn't moved a ton, but you know, it has moved. And so, you know, what are we at on our support here? About 130. I always like to see, you know, hey, where support is and kind of use that in conjunction, because there's two different trains of thoughts here. The first way of thinking of this is saying we can play the technical analysis. And the idea behind the technical analysis is saying, okay, there's a support level along here, and we're going to use that as a spot the stock should likely stay above according to technical analysis. And, you know, that's that play. The other way, and some traders do this where they don't even look at a chart at all. They just come in here and say, I want something that's a higher probability. Therefore, they're looking at something, you know, with that 30 to 40 delta. Again, the 30 to 40 delta is a probability or a proximity of the probability that it'll expire in the money, which would indicate that it has a 60 to 70% probability of being out of the money. So it's strictly playing probabilities. But let's actually see what the 130. Let's do this. The 130, 129. Let's see what that's doing. Oh, that's quite a bit better. That's quite a bit better. Let's look at this. 130/129. That's giving us a credit of 70 cents, right? And 70 cents on that means that our risk is going to be $1, and it's going to be, hold on, this can't be right. Hold on. What am I missing here? Selling the 130, buying the 129. There's no way that's a 70-cent credit. Yes, oh, it's locked. That's why. There we go. I was like, there is no way. This is looking way too good. Yeah, the point being is if it looks too good to be true, it probably is, right? Yeah, let me open that up. And now I didn't realize I'd locked that one when I changed the price earlier. So, okay, this is better. 32 cents on that. It's $1 wide, which means our risk would then be, you know, $1 minus 32, which in my head gives us 68 cents, right? Of risk. And then if we do that, the 32 divided by the 68, the ratio is 47. That's not bad. That's not bad. Maybe we can go with that one. Let's just pop this out to 2 wide and just see what it says. So now we got the 130, 128. So I'm going to throw that on there, 130 versus the 128. And let's see, that's open, so that's 60 cents. So this one may not be doing quite as well. 60 cents, and we have a 2 wide spread. So $2 minus 60 cents is going to be $1.40, right? And if we come over here and do 60 divided by 140, that's going to give us a 42%. So we're going to go with a 1 wide spread on this one. All right, we get a little bit better probability on that return. Well, should we say a little bit better return to risk ratio? So $1 wide. And so with that, if we're potentially risking, we're at 32 cents, so we're risking 68 cents or $68. Now this is where we do need to think about, you know, commissions and stuff, depending on what your commissions are like. But if we have $1,000 of risk in our account and we divide that by the $68 of risk on this particular trade, that's going to say we can get 14 contracts. And so let's go out to 14, 12, 13, 14. We're good there. Let's let that ride. Everything good here. Limit. Okay, I'm going to hit confirm and send. And what do we have? Let's make sure there aren't any, you know, issues popping up. Okay, looks like we can make potentially $448, and then risking that 958 to get that. Go ahead and let's send that off, and we're good to go there. And here's the deal. Now this is interesting because the question was earlier that I want to go back to is why are we doing the April 10th instead of like the 17th? We could look at the 17th And often it's advisable to actually kind of compare and contrast and look at both of them and say, okay, what could I do if I went out a little bit more? And so that's a good thing to be thinking about. Um, but I just noticed, I mean, generally speaking, when we're looking at the delta we're looking at and getting a 0.47 return on risk, that's pretty good. And with less days, I'm thinking, hey, let's make this as short as possible, right? I mean, we want to make it as short as possible all the time, but we have to go. I mean, why don't we do 2 days? Well, we don't go that short because there's just not enough time value that we're selling. So we have to go out enough to get something to sell to make it, worth it. And so generally that's where that 30 to 40 day kind of ballpark figures. And if you're getting in the 20s, you're starting to get on the low end. If you go over the 40s, we're starting to get on the long end. But honestly, sometimes you can squeeze them out, and this happens to be one that still has a bit in there. Let's go out to our chart. We sold the 130, right? So let's go out to our chart and let's see if we can draw a box in here. So we can grab our box, and we need it to be, well, let's do this. I always like to kind of put a little oval around it so I know where we entered the trade. And we need to be above 130. So again, using that support for some love here. Above 130, right about there by April 10th, right there. Boom. That's what we're looking at. So want it to be up here, or just like at least above this line. But obviously, the further it goes, the better off it's going to be, or the quicker we can pull away some of the funds, right? Okay. Let me just check and see, make sure I'm not missing anything on here. Debit spread says, let's see. Okay, a couple questions in here. So should we look at the bid-ask spread for verticals as well? Yes. I mean, in fact, one of the things that I often look for when I build a watch list is looking for stocks that have high, I covered this way back in one of the earlier ones that maybe I had to link back to or revisit again, which is looking for stocks with a lot of volume, and not just volume. There we got filled, and not just volume on the stock itself, but actually option volume as well, because the more volume that there tends to be tighter bid-ask spreads, right? And so a lot of these stocks that we look over tend to be tighter than others out there. So that's always important. Let me see what else came out there. Debit spreads have superior risk reward. Well, yes, and yes, at times, yes. The debit spreads will tend to have a little bit better risk reward simply because there tends to be a little bit more volatility that's priced in to the debit, especially on these put spreads. But one thing to keep in mind is the challenge on something like these bull put spreads that comes up versus like a long call spread is that they tend to hold on to the remaining value. Meaning, if we're looking for the value of it to dissipate to zero, it doesn't go to zero until almost the very end. And the reason why is because stocks don't tend to gap up or crash up as much as they tend to crash down. And so there's always some value. There's not always, but there's often value in there that's just kind of sitting there waiting, because there's always that potential for something to crash it down, which, as I mentioned, tends to happen more often than crashing up. And so there's, yes, we tend to get a little bit more premium on that. And so it helps the risk reward a little bit, but also it makes it a little bit more difficult to hit more of the gain at the end, right? Like, meaning if we're looking to pull it off, like as we're getting close to expiration, the put side will tend to hold on to a little more value longer than the call side. So something to keep in mind, right? Just the little nuances that happen out there. Another question: do we hold to expiration? Excuse me. At times, but often we'll look to exit. In fact, one of the trades that, what was it? Was it Starbucks? SPUX. I think it's the one we hopped in. Yeah, check this out. This one, this is one where I think it expired. Well, it expired right here. We can see the line. That's the beauty of having that box. And so we got in the trade, and you can see this one kind of channeled around. Like a week later, it wasn't really doing anything. And then finally it took off and it hit our target, right? And so we got out of the trade. But this is the beauty about like looking to take the profit off the table and not looking to get every single penny, because again, it takes to the very end to get every single penny. Quite often, unless it's way out of the money, it often takes it to the very end. And then it can come crashing down. Now, unfortunately, this one, if someone was in there, it looks like, came crashing down the day after, but look how close that was, and giving up all those funds that could have been, taken off the table. And so often we'll look to remove it when we get to, an 80% gain somewhere along that ballpark. So that's an important thing. So lots of good questions. We need at least 5 trades. Oh boy. Yeah, we're not gonna get 5 trades in. Let's keep going though. So let's go back. Let's look at a couple others that are setting up. And even if we don't get trades out of these, there's some potential steps. Coca-Cola earlier is starting to bounce. It's sitting at this 32%, 38% retracement. And the day hasn't closed yet, but we'll see if this one holds. That could be a potential for another day, huh? Let's look at MO. MO, hasn't quite made it back to the 38.2 Fibonacci retracement. However, it looks like it could potentially bounce off that 50 moving average. So waiting for some of these to kind of make their mark. MRK, let's see how Merck is doing. Same thing. This is looking to bounce. It did kind of come through that moving average, but isn't quite bouncing just as of yet. So hanging on there. AMAT, let's check this one. Ooh, here we go. Okay, this one, look at this. Ran up, pulled back. Oh, this did kind of fall through. It didn't listen to the Fibonacci's. However, you can see this is another one. Again, looking at the personality, it does tend to find support somewhere near this 50 period moving average, and that's looks like what it's doing today. So let's run some numbers on this and see what we can do as well. So AMAT, let's jump over there and see. And let's start off with the April ones, right? Let's just see what we can do. Let's drop this back to 14 or so. We don't need all of those in there. And so looking at those deltas, let's, where is our support? Let me grab that. I like to have that in mind. 336, 337, somewhere in that ballpark. Okay. So, it'd be nice to sell underneath that if possible. That'd give us a 335 with a 30 delta. So let's click on that. And then let's hold down the control button and click on the 330. So now we have a 5 wide spread. And it looks like we're getting $1.62 for that. So not too bad. What would happen if we go out a little bit? What would happen if we change those to the 17th? I switched on us. So let's do this. Here, let me delete this. We'll just go out to the 17th and create it. We had $1.62 on that one. If we do the 330 on that, now the delta on that one is 29. Interesting. Click on that, and then I'm going to go click on the, these are on $10 wide. I can't do a comparison the same way. Dang it. So this is another point, right? Look at how we have $5 wides here and $10 wides there. So let's look at, I think we're looking pretty good on that as far as the risk reward. So let's come back here and let's look at that. It's changing quite a bit. Oh, these are wide spreads. These really opened up. I don't know if we're going to get build on that. Volatility, when volatility pops up, that can really make a mess of this. So I don't know, we're at $1.10. That's right at kind of at the cusp of it, because if we're at $1.10 credit and we're already pushing it to the midpoint there, I don't think we're gonna get filled on that one. Dang. So, and that's the way it goes. I was hoping to place a trade on that one, but it really widened out since I was last looking at it. MU's trying to bounce now. MU was interesting because it had this almost like this descending triangle. It came up, hit resistance, came down, bounced again, ran up, hit resistance, came down, had a flat support and declining resistance. And typically this would be interpreted as a bearish type pattern, looking for it to possibly drop down the distance of, the wider part of this triangle if it broke out, and now it didn't break out to downside, but that would give us a target. But it actually broke out to the upside. And so the other thing that this can happen is, while that's not typical, when it does, that often can mean that it was simply a consolidation period and has now just taken a breather in the overall uptrend. Sorry, I want to activate this uptrend, and then has now run higher. And so what we got now is a breakout retest, and so possibly looking for it to run up to this ballpark around the 511. And by the way, on my X account, I actually did a YouTube or a short or just a video on this. And so if you go over to my X account at Brett Crowther CS on X, that's mine. Scott's at Scott Thompson CS. Check those out. But I did a video on this about a week ago talking about, hey, we could look for this to pull back and bounce. And so go check that out. But let's go see what this one has, because if this, we're starting to see a bounce here. We're done with the earnings announcement, so that's good. We might even be able to capitalize on some of the implied volatility, which can sometimes still be bleeding off on this. So let's click on this, get some applied volatility on there. Oh, we don't need two of them. We need one. And we got, yeah, it's still up there. You can see this is still up there. It's dropping off. This is the bleeding off I'm talking about, but it still has some room to drop. And so that could possibly work in our favor. So let's just take a look at this one and see if we can't make one more trade on this today. So where are we at again? About 418. Let's go out there. And let me delete this. Let's see what we have on the 17th. Gives a little bit more time. That's about the nice window. These are 10 wide spreads. Let's see. So we said 417. Let's go with 420. That'll be a little bit above that, but we hope that it holds. So if we click on the 420 and then hold down our control button and we sell the 410, we have a 10 wide spread. We're getting 362, right? And so $10, minus the 362 is going to give us, what is that, about 638? 638. Okay, so that's going to be a risk reward if we do this. 362 divided by 638. That's going to give us about a 56. Actually, not too shabby. 56% return on risk. Let's go ahead and do a contract on that. Now, with that, with $1,000 and a $600 risk on here, we can only do one contract, but stay within our limits. But that'll work. It meets all the criteria. So we'll leave it at 1. We're going to leave it at that 357 credit. Going to hit confirm and send. And then just read it over, make sure we're not missing anything. No, like warnings or anything. And we're good to go. Let's send that one off. And then that one, since we sold the 420, right? Yeah, the 420. Let's go out to the chart and let's mark that one up. Come on, gotta get this box out of my way. Get out of my way so I can click on the chart. There we go. Let's draw our box in there. So we want to be above 420, which is right about there. And we did the 17th, didn't we? Oh, we're going to need a little bit more time on this. So I'm going to just draw that. I'm going to drag this over, then activate this again and pull it over just a little further to the 17th, which is right there. So here's our box. This is what we're looking for, to be above this price point by the time we get here. Not really worried about the upside. The higher it goes, great. This is just giving us an indication of like what's the baseline here and what's our deadline on the right-hand side. So bottom and right-hand side are the ones we're concerned about. So there we go. Couple potential, there's 2 trades, right? And several charts that we looked at, hopefully to keep an eye on. Let me just make sure I'm not missing anything on this. Let's see. Snooze, you lose. Yeah. Mr. Brett, does teach fibs? Yes, I do. In fact, I did a class not too long ago talking about how I modified these Fibonacci's, and I'll possibly go back and do that again, because I think they can be, people can use them as a technical tool. Let's see. Oh, thank you for posting the YouTube short, Scott. Really appreciate that. So yeah, check that out. Scott's posting them in the chat. You can click on those YouTube shorts. They're less than 3 minutes. They're quick. They're boom. I have to get right to the point, knock it out. So I'll do another fib one. I'll get that down. The next time I'll probably hit the fibs for you guys again and walk through that and how I can use that. So I'll make a note of that. But thank you. Would I use any OCO orders? Oh, hey, Mickey. No, I don't want to use the OCO orders. We could, and I talked about that last time. It's okay to use them. It's absolutely okay to use an OCO order. Just remember, if you're placing an OCO order, would be a target and a stop. Just remember, if you're placing that stop, understand what the probabilities of that stop being hit are and see if that's altering, the probabilities of the trade from what we expected. Because right now, like this one, we're expecting, it was a 29, so we're expecting a 71% probability, right? So got to make sure the probability of touching the stop would have to be at least 31% or less, or else it's altering our probabilities. And I did a class on that last time, so check that out for those of you who didn't see it. Okay. All right. Well, we're out of time. Excellent stuff. Thank you so much, Scott. Scott's, he's actually a really good friend, plus a good coworker. I've known him for so many years. And it's good to have him on board because he's great. But thank you, Scott, for handling a chat. Thank you for joining me. I'm glad to be back. Good to be with you again. We'll keep an eye on this stuff, and we'll follow up on some of the stocks that we looked at, some of those charts that we looked at next time. But, in between, I'll be posting about those on X. And so keep an eye on that. And coming up next, we got Mike Fairborn doing some ThinkScript. So join him coming up here in about 15 minutes. All right. Till then, I'll see you next time. Have a good one.